Welcome to the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. My goal for the podcast is to help you live a better life in retirement by giving you the tools and information you need in a language that you can understand. I am a financial advisor in St. Louis, Missouri, with a focus on retirement planning. We have clients in 17 different states, and we help them plan for a successful retirement, the retirement of their dreams. Not only from their investments and their retirement accounts, but also we help them with Social Security planning, pension planning, Medicare planning, maybe legacy and beneficiary planning. The list goes on. In this podcast, I hope to share some of the stories, some of the examples and advice that will certainly help you, the listener, with your own retirement planning. Every episode, I like to share stories and insights to help not only teach, but also inform. And hopefully you can pick up some tidbits along the way to help you get your financial house in order and on track for a successful future. On today's episode, I wanted to talk specifically about investing in the stock market. I've heard so many people say that they have lost money in the stock market, or they have friends or family members who have lost money in the stock market. And I wanted to share some perspective around this idea of why some people have bad experiences with investing in the stock market and end up losing money, and why they're so uncomfortable with the idea of investing in the stock market. And then, of course, I'm going to explain why they shouldn't be over the long term. So this is going to be an awesome episode you're not going to want to miss. Before we get into the content of today's episode, I wanted to remind listeners, check out our website, retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. There you can listen to previous episodes. You can also check out our free resources, such as my retirement secret sauce and our 2020 tax planning guide. So check that out on our website. And then if you do have any questions about investing or your retirement, whatever it might be, at the bottom of the website, you can submit your question, and I'd be happy to get back with you on my thoughts and my advice. So getting into today's episode of why people lose so much money in the stock market and why so many people have bad experiences investing in the stock market. So let's first talk about how long the stock market in the United States has been around. The New York Stock Exchange is over 200 years old. The S&P 500 index was started in 1957. So we've got a long, long time that we can look back to see how the stock market has performed over the long haul. And I was reading some research that was done by BTN Research the end of 2020. So it was published December 31st of 2020. And this research was very fascinating to me. It posed a question. It said, okay, since the US stock market has been around, is it true or false? Every time the market has gone down, it's come back. Okay, well, that's true. And then the next question, every time the market has come back, it's gone on to set new highs. Well, that's true. Even with the coronavirus this past year in 2020, the market really declined significantly in March and April, but it really recovered, and it actually ended up setting new highs later on in the year. So if we know the market's going to go down, we know it's going to go up, and we know every time historically it's ever gone down, it's going to come back and set new highs. Well, then the next question is, how on earth do so many people lose money investing in the stock market? And the answer to that is because fear is a bigger emotion than greed. And what I mean by that is so many investors in the stock market are short-sighted, and they're short-term focused, and they're more concerned about losing money than actually making money. There was a famous money manager named Peter Lynch, and in the 1990s, he was quoted by saying that more money was lost preparing for the next correction or market crash than the actual correction or market crash itself. And that was his opinion, but I would definitely agree with him. There was a story of an old farmer that was sitting outside on a porch, and a stranger approached and asked him for a glass of water. And he asked him, he said, well, how's your corn crop doing this year? And the farmer said, I didn't plant any. He said, well, why not? He said, I was afraid of corn blight. He said, well, how are your soybeans doing? He said, I didn't plant any of those either. And the stranger said, why didn't you plant any soybeans? He said, well, I was afraid it wouldn't rain. He said, well, what did you plant? And the old farmer said, I didn't plant anything. I just played it safe. And that's how a lot of people invest when it comes to the stock market. They are so concerned about losing temporarily or seeing a decline temporarily than they are of their long-term growth potential of the stock market. They simply can't handle or deal with the short-term temporary volatility and declines that are so customary of the US stock market. But again, when we look at the BTN research that I talked about, we know the market's going to go up and down. We know the down days are coming. It's just like a rainstorm. We know you're going to get wet eventually, and you're going to be unhappy. But what I want to stress on today's episode is that investing in the stock market is a marathon. It's not a sprint. It's a marathon. You'll probably meet a sprinter who gets lucky. And by that, I mean someone who invests in the stock market over a short period of time and makes a great profit. But investing is a marathon. You rarely find a marathon winner who's lucky. Marathon winners are champions for good reasons. But let's get back to our reasoning of why people have such bad experiences investing in the United States stock market. And I mentioned that fear is a bigger emotion than greed. That's a big reason why. And what I mean by that is that we've got to understand is investing involves subjective decision making. And you may be thinking, what do you mean by subjective decision making? Well, subjective decision making involves personal feelings and opinions and emotions. But when you read a manual, for example, a manual, you're reading objective data. But when you read a blog, you're reading subjective opinions, somebody's opinions or attitudes. But subjective thinking is opinion-based. It's based on instinct and judgment and emotion. So picture someone investing in the stock market and they're being swayed by headlines and news articles and all of these different ideas that are thrown their way. But their decision-making is subjective decision-making, which again are based on their feelings, emotions, and opinions that they hear. And they're going to hear articles and headlines, the market soars 1,000 points, or the market plunges 800 points, the market crashes 2,000 points. But those words, soar and plunge and crash, they sway our emotions and our feelings. And oftentimes, we end up making rash decisions based on those headlines and our emotions. Just imagine you were getting on an elevator and it had an arrow pointing up and it said soar, and it had an arrow pointing down and it said plunge. I don't know about you, but I wouldn't get on that elevator. You got to remember, they're just words. But you might see headlines, market hits an all-time high. And someone might say their subjective, their opinion might be, well, if it's at an all-time high, then it's too expensive. I'm going to wait until it comes back down, then I'll invest. Well, what if the market keeps going up and up and up, and they miss their chance of investing back in the stock market? And there's a big disconnect here because we're making long-term investment decisions, right, that are going to affect our financial life, not only now, but well into the future. Somebody is making those long-term decisions based on short-term attitudes or feelings, opinions, which are solely based on the current news or the current events. And you know how the news likes to sensationalize everything, especially when it's bad news. So the basis of our decision-making is flawed because it's based on short-term, emotional, short-sighted information. And that's why investing in the stock market needs to be a long-term journey, a long-term commitment to your long-term financial goals. It shouldn't be based on short-term moving in and out and trying to time the market and based on events and things like that. In my lifetime, every successful investor that I've ever met made their financial decisions, their investing decisions, based on their long-term goals or their long-term plan. And every single failed investor that I can remember always made their decisions based on short-term news or short-term events. and they paid the price for it. So this research that I was talking about earlier in the podcast, done by BTN Research, which was published in December of 2020, it looked at the S&P 500 index. And for those that aren't familiar with this index, this is the 500 largest US companies that are publicly traded. So just picture the 500 largest US companies. And this index has been around since 1957. So it's been around a long time. But this research looked at the last 50 years. If you had invested in this index, which represents about 80% of the US stock market, right? The S&P 500 represents about 80% of the entire US stock market. So looking back 50 years, just the past 50 years, including 2020, 40 of the last 50 were up or positive. So 80% of the time you would have made money if you were invested in the S&P 500 index the last 50 years. During that time, the last 50 years, the average annual return was 10.9%. That's between 1971 and 2020. So the last 50 years have been remarkable for the United States stock market. So for someone that has been investing in the stock market for quite a while, for the past 5 decades, 80% of the time, the market was positive. So your investments would have gone up in value. So those are pretty good odds. And on average, the average annual return was 10.9%. Oh, and get this BTN research showed that the last 18 years, looking back, the last 18 years, 16 of them were positive. Now, I want to be clear by quoting this research and what the S&P 500 has returned for the last 50 years. I would not recommend that any one person invest their entire portfolio in strictly the S&P 500. There are ways to diversify your risk even further. But we're just looking at the S&P 500 the last 50 years, so we can try to understand how someone loses money investing in the United States stock market when, of the last 50 years, 80% of the years, or 4 out of 5, the market was positive, so you made money. But 20% of those years, you lost money. The market was down. So what does this tell us? Well, if we know for stock market investors, we know that 80% of the years, looking back at the last 50 years, that 80% of those years you would have had a positive return. But 20% of those years you would have lost money or had a negative return. And again, I ask, why do so many people lose money in the stock market if they have the data that shows, historically speaking, if you're patient, the odds are in your favor? Well, there's something that's called loss aversion. And this is, if you're interested, it's this concept that says the pain of losing money is psychologically twice as powerful as the pleasure or euphoria of gaining money, of winning money. So if we know the pain of losing money is twice, for most people, twice as powerful as the pleasure of gaining money, a lot of people choose not to take the risk in the first place, or whenever there's a stock market crash or correction, they feel that pain and they abandon ship. They say, enough is enough. I'm sick of seeing my account or my balance go down. I can't take it anymore. And they panic out and they sell at the exact wrong time. It's like trying to sell your house when the housing market is in the dumpster. That's the wrong time to try to sell your house. Same thing with the stock market. You don't want to sell your investments in the stock market in the middle of a depression. But people give in to their emotions, they panic, and quite frankly, they get scared that things are only going to get worse from here. My mother used to have this painting on the wall, and it used to say, when you're up to your neck in alligators, it's hard to remember that the initial objective was to drain the swamp. And I think of that all the time, that picture all the time when we're in a tough stock market environment, like this coronavirus, when the market just dipped all of a sudden. People saw their account balances go down and go down fast in a very short amount of time. So if you were one of those people, it was easy to forget why you're investing in the stock market in the first place during such a crazy and hectic time in our economy, when people want stability. So when times like that happen, people panic out of their long-term investments in the stock market and they go to something that's more stable because they are looking for certainty in a time of uncertainty. But that's the exact wrong thing to do because you're panicking. But it's easy to forget that the last 50 years, the S&P 500 has been up 80% of the time. The long-term return through the last 50 years was 10.9%. And the reason we're investing our long-term retirement savings is so we can live the retirement of our dreams. We can travel in retirement. We can help fund our kids' and grandchildren's college education. We keep our stock market investments so we can spoil our grandkids for the next 20, 30 years, however long we live. And these long-term investments will allow us to afford the lifestyle that we worked so hard for over the last few decades. So if you want to be a successful long-term stock market investor, there's going to be times when you got to put the blinders on to all the noise that's out there. The headlines where the stock market plunges or crashes X amount of points and unemployment numbers keep rising and rising and rising. You just have to take a deep breath and focus on your long-term goals and why you're investing in the first place. I hope this has helped explain why so many people have bad experiences in the stock market and how you can have a positive experience investing in the stock market, and everybody else can too. I hope you've enjoyed this episode of the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. Again, visit our website, which is retirementmadeeasypodcast.com. I'd love to hear your questions or comments, which you can submit at the bottom of the website. I'll catch you next time for another episode of the Retirement Made Easy podcast. And remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.